If you're running your business through a company, there are three main ways you can pay yourself. And the way you choose has a big impact on how much tax you pay, what options you have for managing your cash flow, and whether you're setting yourself up properly for the long term. I'm Ben Elliott, and I've been helping business owners structure their companies and pay themselves efficiently for over 13 years. Recently, I had a client come to me with two business owners who were both taking a salary. The business was profitable and doing well, but they were paying an extra $20,000 a year in tax they didn't need to pay. We made one simple change to how they withdrew money from the company, and just like that, they saved $20,000 a year in tax. Same business, same profit, just a smarter structure. On the flip side, I've also seen business owners get themselves into serious trouble using Division 7A loans without understanding what they're doing. They think it's a tax saving strategy, but it snowballs into a problem that's expensive and messy to fix. In this video, I'm going to walk you through the three main ways you can pay yourself as a company, when each one makes sense, and why I strongly recommend avoiding one of them unless you really know what you're doing. Let's get into it. The first way to pay yourself is through a salary, just like you would if you're an employee. You're on the payroll, the company pays you a regular wage, PAYG tax is withheld, and super gets paid into your super fund. It's pretty straightforward. Now, this is the method I recommend for most small business owners. Here's why. First, it gives you proof of income. That might not sound important until you actually need it. During COVID, all the government stimulus packages were aimed at employers. If you were a business that didn't employ anyone, you got nothing. But if you were paying yourself a salary, you were technically an employee of the company, and that meant you qualified for the stimulus. The same thing applies to insurance claims. If you make an income protection claim, or perhaps you need to apply for a mortgage, having a salary makes your life a lot easier. You've got pay slips, you've got proof of income. The bank knows exactly what you're earning. The second reason I recommend a salary is super. If you're paying yourself a salary, you're also building up your superannuation. Yeah, you've got to run payroll, you've got to lodge your BAS, and you've got to pay super on time every quarter. And if you miss the super deadline, that payment isn't tax deductible. I've seen that cost clients an extra $20,000 in tax because someone was on holiday and they missed the quarterly super payment. That's why we now get most of our clients to pay super every pay run instead of quarterly. It actually reduces the admin and eliminates the risk of missing deadlines. Plus, from 1 July 2026, paying your super every pay run is going to be the law. The other downside is payroll tax. If you're in a state like Western Australia, your total wage bill hits 1 million and now you're paying payroll tax. If the business owners are also on a salary, their wages count towards that threshold. The second way to pay yourself is through dividends. Dividends are paid out of the company's after-tax profit. There's no PAYG withholding, there's no super requirement. You just declare a dividend and transfer the money. The benefit here is flexibility. You can pay dividends when it suits you. You're not locked into a regular payroll cycle. The other benefit is franking credits. If your company has already paid tax on the profit, you get a credit for that tax when the dividend hits your personal tax return. So you're not being double taxed. Here's the thing. From a tax perspective, paying yourself a salary versus paying yourself a dividend generally works out the same. The total tax outcome is pretty similar in most cases, but there's one situation where dividends make a huge difference. Payroll tax. If you've got two business owners, each taking $200,000 in salary, that's $400,000 in wages. Add in a few employees and you could easily hit that $1 million threshold. What we do in that situation is we take the owners off salary and switch them to dividends instead. Same income, same tax, but now there's no payroll tax. That's how we save that client $20,000 a year every year. The third way to pay yourself is through a Division 7A loan. This is where you take money out of the company as a loan. You don't pay tax on it immediately because it's technically a loan and you're supposed to pay it back. Now, I'm going to be really clear here. I avoid Division 7A loans in almost every situation. Here's why. In the short term, it looks attractive. You take the money out, you don't pay tax on it this year. You spread the repayments over 7 years with interest. But here's the problem. You're not actually paying the loan back. You've already spent the money. And if you do it again next year and the year after that, it snowballs. I've seen clients come to us with massive Division 7A loans they didn't even understand. They thought they were saving tax, but really they were just deferring it while adding interest on top, plus tax on the interest. And here's the reality. 99% of the time, people don't have the cash to make the loan repayments. So what happens is the loan gets cleared by dividend. So you haven't actually saved any tax. You've just deferred it, paid interest on top, and created a mess that eventually needs to be cleaned up. There are limited situations where I might use a Division 7A loan for a very short period of time. For example, if we want to defer income from this year into the next year for cash flow reasons. But as a long-term strategy, no, it's not worth it. If you've already got Division 7A loans and you're trying to figure out how to fix them, there are a few options. We've done restructures where we've moved a business from a trust to a company, and that effectively has cleared the loan. We've also moved investments into a bucket company to satisfy the loan repayment. One client, we helped save $500,000 in tax through a restructure just like that. But the best advice I can give you is this: just avoid Division 7A loans from the start. Those are the three main methods, but here's what most of my clients actually do: a combination of salary and dividends. They take a regular salary for stability, proof of income, and super contributions. And then when there's extra profit in the company, they top up their income with dividends. That gives you the best of both worlds. We've got the security and compliance benefits of a salary, plus the flexibility of dividends when the cash flow allows for it. And if you're in a situation where payroll tax is an issue, we adjust the mix and lean more heavily on dividends. Now, if you're running a company and you're not sure whether you're paying yourself the right way, or you've got Division 7A loans you need help fixing, book a call with us. We'll sit down with you, look at your structure, and make sure you're withdrawing money in the most tax efficient way possible. Links in the description below. And if you found this helpful, make sure you subscribe, because we're putting out a new video every week on tax strategy, structuring, and how to build a profitable business. See you in the next one.